In our Asian fund, which is VG8, the approach to finding new opportunities is actually very similar to our global fund, which is VG1. We look for high quality businesses, so businesses that have strong moats, so high barriers to entry, high switching costs, businesses that operate in favorable industry structures, so monopolies, oligopolies, so therefore have pricing power. We look for businesses that have high secular growth, and structural growth really, so that they can continue to compound over time. That's easy said, but harder to put in practice because often a lot of these attributes are already reflected in the valuation of the businesses. I think a good live example from our Asian portfolio is Rakuten. We came across Rakuten by studying these dominant tech platforms in China, so Tencent and Alibaba. We looked at what they've done very successfully with their business in terms of growing e-commerce, social media, payments, so across many different verticals. And we studied and tried to see if anyone else was trying to replicate this across Asia. And we came across Rakuten, who we think is having a go doing this in Japan. So Rakuten really has three pillars to its business. The first is e-commerce, so it's one of the leading marketplaces in Japan with an offering similar to Amazon. So traditional online buying all sorts of items. Then the second pillar to Rakuten's business is a sprawling fintech operation. So they've got traditional banking with credit cards and loans, as well as digital payments, insurance services, online securities trading. And what's interesting about Rakuten is that it brings all these services together, so all of the fintech and all the e-commerce together through a single loyalty points ecosystem. So we think that's very powerful. If I shop on the Rakuten e-commerce website for some items to get delivered to my door, and for instance, I use my Rakuten credit card, I accrue more points. And so we think it's a very powerful incentive mechanism and a very strong network because then, for instance, if I go and book travel using Rakuten Travel, again, my points accumulate. And so we think they're on the way to creating something similar to WeChat and WePay, like Tencent has in China, or Alibaba with Ant Financial in China. Now, the third pillar to Rakuten's business is a newer venture into telecommunications. So what they're trying to do is essentially they want to start offering mobile phone plans to customers. And obviously that's a very capital intensive and traditionally been more of a competitive space because you have to build a network infrastructure to start offering these mobile plans. Now, what's interesting is that the market has taken a very negative view about these investments into the mobile telco business. Now, we think that because they do have this profitable e-commerce and fintech operation, they can continue to fund the investment into the telecommunications business. But the market is very focused on the near-term capex requirements into this mobile business, and therefore has taken a negative view. Now, the last point worth touching on with Rakuten is that it's led by its founder, who still owns a third of the company, Hiroshi Mikitani, and we sort of see him as a bit of a visionary. He's a long-term thinker, and we really like to invest in businesses that have this type of almost fanatical management pushing the business forward. So I think that's a good example of one of our current businesses. We invested in Rakuten last year, and it's grown into one of the larger positions in the portfolio due to performance, but we still see a long runway for growth. So the telco project certainly is very ambitious, and Rakuten announced its intention to build this 4G and 5G network back in 2017, and since then, I think the latest update is that they expect to spend something like $10 billion US, which is a massive investment in building this network. Obviously creates very high barriers to entry for anyone to replicate. But we think the way Rakuten is going about this mobile investment is very interesting. So a traditional telco like a Telstra would have gone to purchase expensive equipment from vendors like Nokia, Ericsson, or Huawei even. And the way, on the other hand, that Rakuten is going about it is they're pioneering a new type of cloud infrastructure. And so we think that has the potential to provide them with a cost advantage, essentially, and that's what we're seeing them do. They're undercutting all the incumbent telco operators in Japan and pushing very aggressively to gain market share because of this, cost advantage that they have. So we think the market, is at the moment focused on the near-term, short-term losses that it's generating from this investment, but we're taking a longer-term view, and we think that firstly, they'll be able to continue to fund these operations from the profitable existing business that they have. But we really like the vision and the bigger picture of creating a wider ecosystem and improving the customer proposition in terms of offering more services. And, even if the business doesn't necessarily turn profitable, I'm talking about the mobile business, we think they can run that at break even and continue to gain significant share from the incumbent telcos. Ultimately, this is a fixed cost business, so the more subscribers they get, they should be able to leverage that investment. So, we think over time they'll be able to land subscribers given the incentives that are in place from the using and entering the Rakuten ecosystem, which is already very commonly used in Japan. So, consumers do have a very strong incentive to switch from the existing telco provider to Rakuten's. So, overall, we're very excited about what Rakuten is trying to do with the telco business and trying to even lock in consumers even more. The stock is up, 35 or 40% over the last week because they announced the capital raise, which was very positive news for a couple of reasons. So firstly, it alleviated some of the funding concerns that were around for building out this, the mobile telecommunications infrastructure. So, there were questions around how they would fund it, but a lot of these, I think, have gone away for the time being. But it's also very interesting with this recent capital raise in terms of which partners they've brought on board. So some of the key investors have been Japan Post, Tencent and Walmart. So, the Japan Post partnership makes a lot of sense. Japan Post will end up owning almost 10% of Rakuten after this capital raise. And, Rakuten has been investing in their own logistics network to improve fulfillment and delivery capabilities for the e-commerce business. And obviously, Japan Post has over 1,000 outlets throughout Japan, so it will really help with that last mile delivery. It will also help to distribute the mobile phone plans. So, the incumbent telco operators in Japan have got a store network. And so, Rakuten will be able to leverage the existing Japan Post, retail distribution to, sell those mobile plans. Now, the other interesting investor is Tencent. They've proven to be very savvy investors, very successful, and we think they bring a lot of expertise to the table in terms of, their experience in e-commerce and building this ecosystem that we've talked about. So, I think it's a very smart move, and it surprised us that, Tencent will now be on the register. They will own 4% of Rakuten, which we see as very positive. But I actually think the most bullish thing about the capital raise was the fact that the founder himself, who already owns a third of the company, wrote a check for $100 million to reinvest into the business. And, that's as powerful a signal as you'll see. We love to see the management team or the founders of the businesses that we invest in double down on their investment. So overall, we thought it was very positive news, the capital raise, and very excited by sort of the long-term prospects of Rakuten. Obviously, he's been a visionary. He started the business back in the 90s, so he was very early in e-commerce, almost as early as Jeff Bezos with Amazon. We view him as a visionary, and the fact that he constantly reinvests in his business does remind us a little bit of Jeff Bezos. We've followed Jeff Bezos very closely over the years, given Amazon is our largest position in the global portfolio, VG1. So, we do see some similarities there in terms of how he's a long-term thinker, how he's fanatical about the business, and how he wants to continuously reinvest. Not many people out there would have had the appetite to invest over $10 billion in building a mobile telecommunications infrastructure. He knew that wouldn't be good for the share price, and that it wouldn't be taken very well. But he's the kind of leader that has that vision. So we really like that, and we share the same vision because we're long-term investors, and we can sort of see the bigger picture, you know, we see the near-term losses that the telecommunications business is generating, but we also see the bigger picture that he's trying to achieve, and we think it has the potential to be very powerful.